supposed to cover money and banking theory. Remember, learning makes us to grow. To overcome is all about learning. So in this lesson, we are still moving on with money and banking. Remember, we started with the introduction. What's money? The functions of money, the objectives of money, the qualities of money, the history of money. Then we moved to the quantity theory of money, which we looked at the transaction approach, cash approach, and income and expenditure approach. Now, then we move to the banking system. In the banking system, we look at the introduction. We introduce the concepts of banking system. Then we narrow it down to the principles of banking. Then banking operation. Then after banking operation, we looked at the central bank and the functions of the central bank. So today, we are actually starting with the policy instruments. Now, in the policy instruments, these are macroeconomic policies which helps the economy to grow. So if an economy has to grow, we need to look at the following critical elements. So we look at the types of the policy instruments. We have monetary, we have fiscal, we have others which we'll look at, but our major or the fundamental ones are the monetary policy and the fiscal policy. Then monetary policy. In the monetary policy, we'll be actually analyzing the monetary policy. We look at the meaning. After looking at the meaning, we look at the types of monetary policy. Then we look at the instruments of monetary policy, the objectives of monetary policy. Once we are done with that, then we look at the limitations of monetary policy. So these are the areas that we are actually supposed to cover as far as monetary policy is concerned. Once we are done with the monetary policy, we come to fiscal policy. We look at the meaning of fiscal policy. Then we narrow it down to the types of fiscal policy and the application of fiscal policy, the objectives, and then the limitation. So I hope we'll be in this session. I hope you will enjoy the session. So we'll start with the first part, which is the macroeconomic policies, which actually they are policies which are used in controlling the economy operation in a country over a given period of time, which they entails the following. So there are 5 major macroeconomic policies conducted by the government that are of relevance. 1 is the monetary policy, 2 is fiscal policy, 3 is exchange policy, 5 is price and income policy. So national and income policy. So these are the policies which are normally used in macroeconomic sector. So this is the component of the presentation. So we have economic policies, regulation and supervisory, we have monetary, fiscal, we have exchange rate, price and income, national, debt management policy. So these are policies which are normally used in the economy. We have monetary. So we'll actually discuss the first 2, which are critical in the operation of an economy. And the first one is majorly controlled by the central bank. The second one is controlled by the government. Still government, government, government. So these are critical policies in economic policy. So monetary policy. What is monetary policy? The instrument which is used by the government to control the circulation of money in a country using apex bank of a country. When you talk about apex bank, we are talking about the central bank. Other countries call reserve banks. Like now in Kenya, we call it central bank. In USA, it's called reserve bank. In India, it's called reserve bank. The policy helps in improving economic growth, A public intervention measure aimed at influencing the level and pattern of economic activity so as to achieve certain desired goals. The policy which influenced the public stock of money substitute or public demand for such asset or both. So this policy is influence the public stock of money, which is money at hand, or public demand for such asset or both. Determine the liquidity ratio of the public. So it shows us how much liquid money is in the bank or is in the public. Control the boom and depression. Remember, boom is a period whereby the prices are good, the economy is doing very well. Depression is whereby we are facing challenges to buy goods, to sell goods, and especially when there are catastrophes. Like right now we have pandemic, we are moving into depression. Remember, we had a depression in 1928, which made the countries to change their policies, and the policies which were used were mostly monetary policies and fiscal policies. The first policies to be used to bring back the economy or to change the direction of an economy are actually to monetary policy and fiscal policy. So the objective is to enhance productivity, activity in an economy by attaining full employment and stabilizing price level. So the aim of monetary policy is actually to bring forth full employment and stabilize price levels. If prices are not stable, we'll have inflation. If we have unemployment, we will create a problem in an economy. So that's why the monetary policy comes in. And right now, most countries will be using the monetary policy to control their financial activities. So can we look at the objectives? Why do we need monetary policy? Number one, full employment. The attainment of full employment. So monetary policy helps us to attain full employment. More money in the economy creates jobs, increase investment, and this makes people to get jobs. Full employment. Unemployment is a problem to an economy. Underemployment is a problem to an economy. So we need full employment. Number two, price stability. The achievement of price stability. So through monetary policy, we'll be able to achieve price stability. Now we'll look at this. How can we achieve price stability? Remember, inflation causes higher rise in prices. Deflation causes low or decrease in prices. So we need to control the price level. Stable economic growth. Attainment of economic growth. Remember, every country. Now the policy of developing countries is economic growth. The policy of developed countries is economic or sustainable economy. So these are two different objectives. So for developing countries, economic growth. For developed countries, we talk about sustainable economy. So you move from economic growth to sustainable economic growth. Stability in foreign exchange market, maintain equilibrium in balance of payment. Now this is very important, whereby the monetary policy will help us to balance the import and the export, which play a role in the foreign exchange. If the value of our currency is low, then we need to bring forth some measures to actually activate and stabilize our currencies. Financial market stability. The creation of sound banking and financial institutions to mobilize saving for capital formation. Now, this is very important again. A stable economy is based on financial market stability. If a sound banking and financial institution is mobilized, which helps in making the public to bring forth their money. So the public sector or the house sector will actually save their money into the financial institution. The financial institution will provide finances to the government sector and the private sector, which brings forth development. interest rate stability. Desirable economic objective because volatility in interest rate creates uncertainty about the future, and this can adversely impact on business and consumer investment decisions. Remember, a stable interest rate brings forth economic growth. If the interest rate is not stable, fluctuational, it means will not be attractive. The investors will not be willing. Higher interest rate creates a problem. Lower interest rate creates a problem. But a stable interest rate brings forth good management and development in an economy. So these are the objectives which are critical in monetary policy. So can we look at the types of monetary policy? Monetary policy design change as per the goals set for the monetary policy and the emerging economic scenario. So you design a monetary policy on the basis of what are you wishing or willing to achieve. At the same time, what are the scenarios in the economy? The monetary policy is characterized as follows. So monetary policy has been characterized as follows. 1. Expansionary policy. Policy aim at encouraging spending on goods and services by expanding the supply of credit and money by lowering the policy rates, bank rate and repo rates, lowering the reserve requirement and purchasing the government security from the market. Remember, expansionary policy will help create management of jobs in an economy, stabilize the prices in an economy. Now, expansionary policy is very critical for an economy in the sense that they will pump more money into an economy. More money will be pumped into an economy. And how is that possible? There is supply of credits. There is more money being supplied to the market. So meaning that more money in the market, more investment, creation of jobs, booming economy. 2. Contractional policy. A policy aimed at preventing inflation by contracting the money supply. Contraction in money supply is achieved by increasing the policy rate, increasing the reserve requirement, and purchasing the government securities from the market. Again, this is now the opposite of expansionary policy. If you want to control inflation, then we throw money from the public, pumping money out of the economy into the government. That reduces money in the hands of the public. Counter cyclonic policy. Policy aimed at moderating the cyclical fluctuation in the economy and stabilizing the economy around its trend, backed by the following counter-cyclical measures. This is again very critical measure.